this is Brian Hackney, and I am going to show you our trading system that's called ChannelMax. This is a system that has probably been nearly a decade in the making. It started originally with this blue channel that you see. I actually created this channel probably 7 years ago. I received awards for it and I was published for it. And it's much different than many of the channels that you see in the market available as indicators today. If you are not familiar with trading and looking at charts, I want to just give you a brief rundown. Okay, there's two kinds of analysis. We have fundamental analysis, which looks at a company's financials, their earnings reports, basically anything that's not on a chart, anything that's financial, that's numbers. I don't believe in fundamental analysis for one fundamental reason, and that's because companies lie. And it's not just the small companies, but take a look at companies like Enron or Global Crossing, MCI, examples like this. So if the information that's going in is bad, the information that's coming out has to be bad. So what we do with technical analysis is we look for what smart money is doing. And smart money is quiet about what they're doing because they don't want you doing the same thing. What we know is if we were to be looking at a period that started approximately right here, this is the right edge of the chart, we don't know anything that happens above. In this area, smart money would be accumulating shares, and they would be doing so quietly. Okay? What our job is in technical analysis is to uncover the subtle hints that show accumulation or distribution when they're selling at tops like this and the market's about ready to fall. Now, when the market starts moving up, these shares that they have accumulated, they're not buying more, they're selling into demand. When you have demand, you have increasing prices and they can make more money. I want to also quickly show you what a chart, a technical analysis chart, actually is. Okay, we're looking at a daily chart. We can look at all different kinds of time frames, weekly, hourly, minute, 15 minutes, 30 minutes, but in this case it's a daily chart. Each bar, this is a bar, represents 1 day of trading. When the bar is hollow, like this bar, that means price opened at the bottom of the bar. This is the highest price it traded that day, and this is where it closed. So we had a stock that opened low, went up during the day, and closed quite a bit higher than it opened. So this was a strong day for the stock. When the bars are filled in like this, that means the stock opened here. This little tail down here is the low of the day, and this is the close. That means price opened at a fairly high level, it went down and made a low, and it closed near that low. What's important about the closing price is close at the close. That's where the professionals trade. And if we look at a scenario like this, where here's our open, here's our low for the day down here, the stock traded very high, but the professionals at the end of the day were not willing to pay these kinds of prices, and they closed the stock over here. So this is a very small candle. These are called candlesticks because they represent a candle body with a candle wick. And like I said, the wick it represents the high and the low. So at a point like this where we see not a lot of movement, that's typical of reversals. So we had a little uptrend, we got this small body, and then it reversed to the downside and went sideways. If we clear this real quick and we take a look again, we see where the price opened here, closed way up here, and we got a continued rally. We still haven't hit these highs over here in this particular stock, which is ticker symbol CNQR, Concord Technologies Incorporated. So that's basically how this works. What my channel does is my channel takes a specific number of days. It looks at the high, the highest high, and the lowest low over that specific number of days. In this case, we're looking at 50 days. So we're looking at how the stock trades, what the average volatility is over 50 days, and we're creating a channel, okay, with a standard deviation attached to that. So we expect to see stocks trading somewhere within this channel. This is a 50-day moving average, this light blue line. So take 50 days of closing prices, add them all up, and whatever you get, those 50 days added together, then you would divide by 50, and that gives you your moving average, your average price. So over the last 50 days, even though price is way up here, this is your average price paid over the last 50 days. When we look at charts, there's a couple things that people typically look at. And let me just back up this chart so we see a little bit longer view. And this is our test period here in gray. So what people look at is two conditions, one called oversold and one called overbought. That means it is so far away from what is considered to be the average value that it's oversold, and people think, well, it's oversold, so it has to reverse at some point very soon. Well, over here it was oversold, but it didn't reverse. Over here it was oversold, it didn't reverse. Over here it was oversold, it didn't reverse. It continued to make new lows. So because the stock is oversold does not mean it's going to reverse. Over here our stock was overbought. Look how far away it is from average value. But this continued to make new highs. So the mistake people make is they see something and they say, well, it's overbought or oversold, and they trade against the trend. What we've done is we've taken this channel that you can see here in blue, and we're specifically looking for stocks that are below or above value. And how we determine our positions, as you can see here, when a stock crosses below the channel, you see it says short over here. When it's below that channel for 2 consecutive days, on the next day, buy or short, in this case short, the stock at the open. What short means is for every dollar or every cent this stock goes down, that's money in our pocket. When we buy long, for every dollar it goes up, that's money in our pocket. So over here you can see a buy, and over here you can see a short. In both cases we made money. We made money going down, we made money going up. Okay, and that is where a lot of funds cannot compete, because they cannot go short, they can only buy. And when the market is in a free fall, the only choice they have, and they have to stay invested in the market, is to buy these stocks that continue to fall. We have other options. We can sell them short and we can make money as they fall, and we can buy them when they go up. So as you can see, here's our short sale. Over here is our buy. We would still be long this stock. There's no risk management applied here. This is a test. It starts on September 1st, 2008 over here, and it ends on September 1st, 2009 over here. It is 1 year to date. Okay, and I will show you. Watch list. It's not necessarily the best watch list, but I want to show you that I'm not overfitting or customizing this to get incredible results. We're using the Standard & Poor's 500, which is an industry or a stock market benchmark. 500 largest companies in the US. And again, under rules, you can see down here, starts September 1st, 2008, our test, and ends September 1st, 2009. Here's our rules. So we have no risk management deployed, and risk management is really the golden goose in trading. It's what really allows you to make money.